Alright everybody, this is going to be a very basic video about your P&L document, or which stands for profit and loss. And I usually do this in Excel spreadsheet in Excel. And mine doesn't really look like this. Mine is a little bit more fancier, it has different things, but I'm not obviously going to share that information here. And so I kind of try to recreate it in a much simpler version. And so I'm assuming that most of you know how to set this up, most of you know how to work in Excel, but for those of you that don't, just watch these first videos and hopefully it will teach you something. But basically what I have is I have a couple of columns, and this would be an example for a monthly P&L. And so as you can see, there are a total of 35 trades, which is in line with what what a common trader would have. And so most traders have maybe 2 or 3, maybe even 4 trades per day. Some who are more active will have more, but rarely will a day trader have more than 10 trades out there per day. Okay, and obviously I couldn't make this document too large to make it fit into the screen, so for now we're going to use 35, and we're going to assume that this particular trader is something of a part-time trader, and he trades maybe about 2 trades per day, maybe a little bit less. Okay, but basically what you have is you have a buy column and a sell column, which is where you directly put in your entries and exits. Now if you're a short seller, if you had a short, you would reverse that. So you would put in your entry that you sold it at or shorted it here, and then when you covered it, it would be here. So when you're shorting, you put your first entry here, and then your exit is here. And when you're buying, your entry is here and your exit is there. And then very straightforward, you put in your shares, how many shares you had, commissions, and then this would calculate your profit or a loss. And so let's just double click on that cell and just show you real quick how it's set up. And again, it's very straightforward. So you would have an equal sign and then parentheses, and you subtract the cell, and you can just click on it. So basically you would subtract, the buy, which is the green right here, from the sell. Okay, so sell minus buy, close parentheses, times basically the number of shares minus your commission, and just hit enter, and this is your profit or loss. And then if you want this applied to all cells, you just drag this down. Okay, drag it all the way down. I'm not going to do that here, but basically Excel is going to automatically calculate this. And now the next thing is the position size. I don't have this. You don't need it either, because it's just extra information you don't need. The only way you would use this is maybe to calculate how much risk you are assuming based on the size of your position, but I'm just using this for this video for this purpose. But it's very straightforward. You can either choose the buy or a sell, or maybe you can average them out. I just randomly selected the buy times the number of shares. So this is my standardized, so to speak, position size that I calculated. And then your total profit or loss, as we can see here, is the sum of all these profit and loss cells here. So it's the whole entire column, and as you can see, it's a range between this cell and that cell. So basically what you do is you just basically select everything, okay, and hit enter, and that is going to tell you how much you are gaining or losing. Now this particular person here, he is down by almost $200 on the month. And if you are one of these people, don't let that discourage you. A lot of traders, when they're beginning, they lose a lot more. And this is why you shouldn't go out there and quit your job. This is why you shouldn't put your entire savings into this. I personally lost over $20,000 before I had that epiphany, before I had that moment where I just said, okay, this is it. This is it. I understand what I need to be doing. I saw some repetitive patterns in my behavior that I corrected, and I also became more comfortable with the charts, and so now charts are becoming more natural to me, and eventually you will get there too. But first, before you do that, you will need to pay a tuition, and that's why it's so important to pay, for your for all these, educational videos and all of that. And I'm not, at the moment, I'm not charging for any of them, so don't think I'm trying to pitch anything here. But there are people out there who are selling webinars, and a lot of traders see these webinars, and they are, to the normal person, they're very expensive. And so they see a webinar that's $1,000, and they're like, are these people out of their mind? I mean, I'm gonna pay $1,000, and then the next day they turn around and they lose like $10,000 on Goldman Sachs. So understand that you're gonna lose anyway, in the beginning stages, so might as well lose on your education, right? But it would be nice not to lose. And so we're human beings, we have emotions, so it's hard to follow discipline. For the most part, we're all going to have a bunch of losers before we start becoming profitable. And so what I want to discuss here are just small little details that you can change to put the odds in your favor. And so obviously you can get educated and do all those things, but there are things you can do just without even pulling up any videos about trading education, without even reading a book, and they're very common sense. And the first thing that you need to understand is commissions. I mean, that's the first thing you need to scrutinize when you're a beginning trader. And so this commission is round trip, so you would pay $10 for your entry and then $10 for your exit. And so this would be something like an E-Trade. I think E-Trade is about $20 both ways, and that's at this moment, so it might change when you're watching this video. But let's say you go for somebody else, and there are brokers out there that are as cheap as $5 both ways. I use interactive brokers, and my average trade is about $3.50, $4. So round trip would be no more than $8. But for interactive brokers, this is not something that a beginning trader would go for. Number one, they want you to basically close out your positions by the end of the day if you have a smaller account. And their platform is a little bit confusing, so it's not something that a beginning trader would use, okay? And their margin accounts are a little bit stricter too, okay? But at any rate, so what I'm trying to say is more than likely you will have something like an E-Trade, Scottrade, TD Ameritrade, or something to that effect. But let's say you switch to Scottrade. Not that I'm trying to promote them. There are brokers out there that are much cheaper than them. But let's say Scottrade is $7 each way, so $14 round trip. Okay, so remember, this person was down by $200, 196. So just by changing the commissions to be $6 cheaper, they are all of a sudden turning positive. And again, this is only on 35 trades. So imagine if you had 70 trades, if you had 100 trades. So the larger the number of trades, the bigger this change is going to be. So all of a sudden we turn positive. Now what if you were to change your position size? And I know that $36,000 is a very big number for most people out there, for most Americans. But in trading, when you're trading large caps like I am, for example, it's really not that big of a number. Now when you're a beginner, you should stick to smaller position sizes. Don't think that I'm encouraging you to move up your position sizes in this video. No, that's not what I'm trying to say. But I'm just using this as an example. And so I trade large caps, and large caps have just enough volatility for me. And so I'm anticipating that I should maybe gain about a very small fraction of a percent. So maybe I'm gaining 0.3%, 0.6%, If I am swing trading, I'm gaining maybe 2 or 3%. But basically I'm just looking for these small moves in an equity that will make me large profits. And so obviously, the smaller this change is, the more money you have to put out there to make, that much money. And a lot of people, they have these small accounts, and so maybe you have $5,000 or maybe $10,000, and they really don't see a way to trade. And so what a lot of people do is they go into penny stocks. And there are ways to trade penny stocks when you're a beginner. First and foremost, if you don't know anything about penny stocks, you should not trade them independently, because they're the most risky stocks. So they can give you a 50% gain, but at the same time, most of those penny stock companies are worthless. They're worthless. So even if you get a company at, I don't know, 12 cents per share, if they don't have a product, if they basically are just a bogus company trading out of somebody's basement, they're worth zero, right? And people think, oh, okay, this company is worth $1, it's cheap. No, it's not necessarily. If it's just a bogus company, with these fake press releases, it's not. And so what happens is that they go out of business and you lose all your money. Okay, so when something goes goes to zero, you've lost everything, right? It doesn't matter that each share was 12 cents or $5, or it doesn't matter, because it went to zero. You lost everything that you invested. And what people usually do is, they realize there's a risk in penny stocks, so they will go to these gurus that have these newsletters, and they send them these trade alerts every day for those penny stocks. And I'm not necessarily discounting them, because there are some really good people out there who really know how to pick penny stocks, because it is an art. It takes a lot of talent to pick penny stocks. It's a lot harder than anything else out there in trading. And so they go out there and they really do find these penny stocks, and they send you these alerts. And there are legit services out there, and their members make money off a small account that's $5,000 or so. But you have to really be able to pick them, because there are more that are not legit than there are the ones that are legit. And usually what these people do is they will buy that same stock, they will accumulate it, and then they will send you that newsletter in your email that tells you, oh, this stock is about to bounce, this stock just had a press release, and this stock is going to introduce this new technology. And so most people, they see this in their email and they're thinking, oh my god, this stock is going to just break out and I'm going to buy it. And they go out there and they log into their account, and most penny stocks are limit orders. So by the time they type in their share size, the symbol, the limit, price that they want, and maybe they see this email one day after it was sent, and they already see the breakout, so they're thinking it's going to continue higher, and they buy the stock, and next thing they know, they're in the red. And that's precisely what these newsletters do for the penny stocks. The person that sends them buys the stock, so that the people that read the email go out there and buy it from them, and he's the one making the money. Whereas the poor people that were subscribed to the newsletter, they are essentially left holding the bag. They're essentially left in a bad trade. And I kind of went off on a tangent, but I just wanted to warn you guys that just because you have a small account doesn't necessarily mean that you must basically be okay with these bogus penny stock newsletters. So go out there and test them first. So even if you sign up for one of their services, test them first. Do a little bit of paper trading to see if you really were to buy this stock, what would happen. Would you really make money? And paper trading is a little bit tricky with penny stocks because there is a really wide spread between the bid and the ask, so you don't necessarily know how much, what price you're really going to get. But nonetheless, test them, see what they are doing, and see if you really are going to be profitable, or are they really just unloading these stocks on whoever is willing to take them from their emails. Okay. Now, having said that, let's go back to position size. And so the first thing we did is we just basically changed our broker and we lowered our commission by just $6. Okay, so we just lowered our commission by $6, which is a very small change. Okay, only $3 each way. Okay, and now we want to look at this position size. And so $36,000 is a lot of money for most people out there, right? But your broker more than likely is going to give you a margin account. And a regular margin account usually gives you double the amount that you have. So let's say you have $10,000, your margin account would give you $20,000, and these you can hold overnight. Okay, but the problem with them is that you will start paying interest on them, and usually interest on these smaller accounts is about 7-8% or so. Okay, it depends on what brokerage firm you use, but I found that about 7-8% is on average the interest rate, which is a lot of money. So in essence, they're telling you your stock needs to go up 7% for you to break even. Well, if you follow charts, you know that no stock goes up 7% overnight. So essentially, this is a loser's game. Okay, but the good thing about margin, even though it's an interest-bearing account, if you use it just intraday, in other words, if you buy and sell an equity the same day, so you close it by the end of the day, you are not paying any interest. So most day traders, they take advantage of this. So I'm not paying them any interest. So you may ask, well, what's in it for them? Well, what's in it for them is that you are providing liquidity in the market. So the benefit is you going out there buying, selling, buying, selling, buying, selling, and this really is what drives the market. So you are providing that benefit to the market, but they are in essence waiving the interest, but you must close the position by the end of the day. Okay, now another benefit to margin accounts is that you are able to sell a stock short, and so you can't do this with a regular account. You need a margin account to be able to sell short. Okay, and so most of us out there have a margin account, not necessarily because we don't have any money, but because we want the ability to short sell a stock. Okay, but then you have these accounts where the this brokerage account is going this brokerage dealer is going to give you a 4-to-1 margin, and generally for this you need to be a pattern day trader. Now there are exceptions for this, so if you're actually a professional trader and you have the licenses, you can kind of circumvent this rule, but for most people out there you need a 4-to-1. They give you a 4-to-1 margin, but you need $25,000 in your account at all times, which would label you as a pattern day trader. And also what this does is that it allows you to basically, it gives you the freedom to buy and sell stock as much as you want. Whereas when you're not a pattern day trader, you can only do it a couple of times per week. And I have a whole video about this, so I'm not going to go into detail. But what I'm saying is that if you have $25,000 or more, you will have 4 times that to actually trade with, which would be a leverage of 100,000. So 4 times 25 is going to give you $100,000. And so you're going to have this available if you have $25,000. But the problem is that if you don't know what you're doing, if you don't have enough education, you're kind of taking a chance here. So stick to these smaller positions, even though they may not make you more money. But let's say that you are, you do have some education and you notice that your trading setups are working out, and you kind of wondering if you should go to the next level. Okay, so you've tested yourself, you are becoming profitable. So let's say this person wants to increase his position size, and let's say he wants to double it. So let's say instead of 1,200 shares, he goes up to 2,400 shares. And let's just basically make all of these cells have the same position size. Okay, so now all of a sudden, instead of trading $36,000, we are trading $72,000. From flat, we are making $500 a day. Okay, and as you become a better trader, you start to discriminate a little bit better. What new traders generally do is they get too excited about an entry and they get too excited about an exit. And so, basically they may see a certain level of support, but they may buy ahead of it because they're just scared that they're not going to be able to enter this trade. And you shouldn't think like that. You should be an all or nothing kind of person when it comes to trading. So, with your entry at least. And so, if you have a set entry, well, guess what? It needs to get there. The chart needs to get there. Otherwise, you're not going to get it. You're not interested. You have to be very picky about your entries. And so let's say this person now, after some experience, decides, well, you know what? I have been getting in too soon with my trades. So instead of this $30.20, I'm going to enter at $30.19. Okay? So let's say what 1 cent could change in his trading. Okay? Well, from $500 in profit, he is now up almost $1,400, almost $900, maybe a little bit less, okay? Just from 1 cent difference. And you can kind of change this into some different things too. So some of your cells, maybe a little bit higher. Maybe you're not letting your profits run. Maybe you get scared when you see that you're gaining a profit. And then you realize after you've taken your profit, the chart goes up a little bit. Now, don't get greedy. Obviously, that's not the point. I'm not telling you to wait for 31 bucks. But maybe if you see some behavior that you're repeating here, maybe you're taking your exits too soon, then you can correct that and make even more. Okay? And so, what I was trying to show you in this video is that little changes in trading is what makes you profitable. Okay? So, changing your commission structure should be the first thing. Ask yourself, how much am I paying in commissions? And then you have to look at your entries and your exits. Are you, getting ahead of yourself with your entries? Are you also getting ahead of yourself with your exits? Okay, could you get more out of your trade? And then also a lot of these losers, go back and review every trade. I'm sure there was a signal that told you not to even enter this trade. Okay? Maybe there was something telling you not to take that trade. Don't take this trade at all. Don't take that trade. And all of a sudden your percentage winning, your percentage of winners is going up. Okay? And just kind of look through and analyze what you're doing, because in trading it's all about the details. You saw what 1 cent could have changed, what changing your commission structure could have changed. And so all these things added up is what's going to make you that profitable trader. You will not have that one trade that just makes you thousands and thousands of dollars all of a sudden and doubles your account. No, that will not happen. So it's these little accumulations of improvements that will make you a better trader. Okay? And also your education. Okay? What most traders do when they're beginning, they get too stubborn and they just let their loser run. And I know it's a cliche and everybody just says, don't let your loser run. Well, easy said, do it actually. And so what traders do is that they basically let their loser run. So instead of taking a quick loss that's only a little bit maybe a couple of cents. They let their loser run, and next thing you know, you're down a couple of bucks. And on a $30 trade, being down 28 bucks, okay, on one trade, puts you $3,600 in the negative. So it's these small little changes that make a difference. Do you want to be down by $3,600? Or do you want to be up by $1,500? To somebody, this is a whole paycheck in a month. Okay? So imagine once these things start adding up and you start building up your capital more and more, 1,000 here, 1,000 there, it may not be much, but before you know it, you have that nice size account and you can increase your position sizes, and they're not going to be $36,000 anymore. They're not going to be $72,000 anymore. They're going to be up there. They're going to be $100,000 and up. And before you know it, this is becoming your, regular source of income. Okay? And, if you're going to give the market that big loser anyway, which we know most traders do, they go out there and they have loser after loser. Okay? And now we're into, double digits here. But this is easily achievable. Okay, you can get there within days. You can have that loser within days. And we're all humans. It happens to most of us, and this is a learning curve. But make your learning curve as cheap as possible. It's kind of like going to a college. You know your budget. You know that if you're coming from a middle class family, maybe lower middle class, you know that you may not be able to afford an Ivy League education, and so you go out there for the public schools and you pay maybe $10,000-$12,000 a year in tuition. Why? Because you can afford that. And so same thing here. Understand that when you have this loser and you can't afford it, well, cut it short. Instead of $25, as soon as you see it hit $29, cut it short. Cut all these losers short. You don't want them. Okay? And even though you might have lost 2,300, you didn't lose 13,000, okay? And so most of us go through this. This is completely normal, but keep them as minimal as possible and consider this your tuition. And again, like I said, if you want to use this anecdote, if you're a trader with a small account, and any trader really, you cannot afford an Ivy League tuition. And so cut your loser short. Have your budget, so to speak, for your tuition. Okay? Don't expect to turn a profit right away. Okay? This is going to be your tuition, and you're going to have to learn. Okay? But cut them. Cut these losers. Make it as small as possible, and maybe even, you're going to be able to turn a profit. It's these accumulations of profits that are going to make you a better trader. But if you're going to lose anyway, right? Use this money on actually educating yourself. Go out there and buy a program, from somebody that you trust, somebody whose methods you really like. And I'm not really pitching anything that I have. My education is free on my website right now, so I'm not charging anything for my educational videos. But quality things, if you see some good things, and it should be worth it. So a lot of people see these webinars and they say, well, this webinar is $1,000, I can't afford that. And then they go out there and have this loser. They lose $10,000 on Goldman Sachs the next day, and they haven't learned anything. They haven't learned anything, whereas that webinar might have been 5-6 hours long. Okay, but they basically learned some good quality setups and rules that they can use for life. Okay, so understand that don't take the big loser, but losing small is okay, especially if you're new. It's expected. We're all human. Psychology, we always want to be right, but as long as you are learning, as long as you have this willpower, as long as you have this passion for learning about trading, if you can stick around, you should be fine. And they say that usually if you stick around trading past the first year, then you're safe. You're gonna do that. but most traders, they fail within the first year. And so if you can make it past your first year, you should be okay. But don't go out there and put in your whole entire savings account in trading. Don't go out there and use margin to the fullest. As a matter of fact, when you're new, don't use margin at all. I don't care how small your position is. Your aim should not be to make money. Your aim should be to learn. Okay? Alright guys, have a great evening, and I will try to post some more videos very soon.